Active versus passive management with investing. Now, this is something that I find super interesting. And, passive investing's been all the rage for over a decade, I would say. Just buy an index fund, sit back and let the market do the work, right? Well, maybe, but what if I were to tell you that active management still has a crucial edge, especially in today's volatile world? In this video, I'll break down why active management isn't dead when it outperforms passive, and why the smartest investors still believe there's alpha to be found if you know where to look for it. So, the case for passive investing and how it emerged. To be fair, the rise of passive investing made sense. For years, index funds performed most active managers. They offered lower fees, instant diversification, and market matching returns, all without emotional decision making. When markets were rising steadily, especially from 2009 to 2021, it was hard to argue against simply owning an S&P 500 or an MSCI World Index. But here's the problem. Passive investing assumes markets are always efficient, that prices reflect all known information and reality. That's only true some of the time. So why active managers matter and are mattering more now than ever is that the world we're in today is not calm, predictable, one that was built for passive investing. It's just not. I mean, you can see the volatility in markets and, higher volatility, inflation, rate hikes, and geopolitical tensions are shaking up markets. Active managers can rotate sectors, hedge risk, and protect capital, something index funds cannot do. You also have market concentration. This is huge, and a lot of people aren't aware of this. In many indices, it's a handful of mega cap stocks that dominate performance. If those falter, passive investors suffer. Active managers can rebalance away from overvalued sectors and, make sure you get kept on track. And then you have price inefficiencies in smaller, less followed markets like emerging markets or niche asset classes. Skilled managers can still find mispriced opportunities, which can result in sizable gains. I mean, obviously, you've got to make sure that you take risk into account here. So in short, when the easy money era ends, skill does matter. So where active outperforms passive is, and I wanted to provide with you, a couple of concrete examples with this. Historically, active management tends to outperform in certain areas, and that would be volatile markets when trends reverse quickly. Active managers can pivot while passive funds stay locked in. So, if we saw a massive tank in markets, the passive just holds that out. Also, small and mid-cap stocks, less analyst coverage means more inefficiencies to exploit, which an active manager can do. Alternative assets, private credit, real estate, art, wine, whiskey, you can't index those efficiently, should I say. Skilled managers create value through research, timing, and also structuring deals. And also downturns. Passive investors ride the full drawdown. Active managers can raise cash, hedge, or shift and become more defensive. So it's not about beating the index every quarter. It's about controlling risk and compounding smarter over time. I personally do a mix of both, and I think passive has a place in every portfolio, just as does active. But Drop us a comment. Let us know your thoughts. Hit the like, hit the subscribe. Appreciate you watching. If you have any questions, drop us an email at info@expatmoneychat. Much appreciated. Cheers.